Hey guys, it is Patrick, your San Antonio based real estate agent. And in today's video, we're going to be talking about this idea of cash to close. How much cash do you need to bring to the table? And I don't literally mean cash. Hopefully you wire it to your escrow officer or title company, or you bring in a cashier's check. Don't bring cash, especially don't bring this much cash. But you're going to hear this idea of cash to close. How much cash do you need to bring to the table in order to purchase your home or close on your home? And there is a little bit of misnomer here when it comes to cash to close, because a lot of people think it's just your down payment, your 5%, your 20%, your 3.5%. That's what most people think about. But in the broader scope of what home purchasing is all about, or how people purchase homes, is that a mortgage is often underneath that home. And when we mean underneath that home, most homeowners use a mortgage to purchase their home. Therefore, there are fees associated with that. And then we also have title fees that you might have to incur, as well as escrow fees. So we want to talk about that as we talk about cash to close, so that you understand how much cash you're really needing to bring to the table in order to close on your home. So let's take a look here at cash to close. So what is cash to close? Well, at a broad sense, cash to close is the cash needed to take possession of the home. So obviously we can't just take possession without buying something or paying for something. But cash to close is a very narrow term in that it also identifies a portion of the amounts that you're going to pay towards your down payment, towards any mortgage related fees, property related fees, and escrow fees or escrow amounts that you're going to need to have with your mortgage company. So that's kind of the broad sense of how much cash you're needing to bring. When we talk about cash to close, we really can dissect it into like three different buckets. So the first bucket here is the down payment, and that's the obvious one that most people talk about. So you might take out a mortgage product that requires a 5% down payment. So this would be 5% of the total purchase price of the home. Some might have 20%, some might have 3.5%, and others might have 0. So that is one of the bigger chunks to the cash to close. The other one, or the other bucket that we have here, is the closing costs. Closing costs is the related cost to actually purchase our home. And unfortunately, it's not like you going out to the store and buying something from the store where you know you're going to pay the price on the shelf plus sales tax and then you're done. Closing costs is that sales tax and other fees associated with purchasing a home. And there are a lot of them. And that is a good portion of our cash to close. So we not only have to save for the down payment, we also need to save for the closing costs. And the last one here, we're going to call prepayment. So the last bucket is the prepayments. Prepayments are expenses that you would incur as a homeowner that have to be prepaid. Examples of this would be the property taxes, insurance, and when we mean insurance, home insurance. You may have a private mortgage insurance. So there are some prepayments that are going to be collected at the closing table on your behalf, and that's going to be used to pay for expenses related to your ownership of that home. So those are the three buckets. Let's kind of dive a little bit deeper so that we understand all the cash that's necessary to close on a home. So the biggest one here is that down payment that represents a percentage of the home's purchase price. So again, that's an easy calculation. We take the purchase price, we multiply it by the down payment required for the mortgage product that we decide to take out or recommended to us by our mortgage loan originator. So that is an easy calculation to get, and it often is the most the biggest amount of the cash to close, so our down payment. Now, it's also important to know that down payment percentages can vary based on the mortgage type or the mortgage product that you decide to take out. For instance, it can be low as 0% if you take out a VA or a USDA loan. Those are two specific products that you can take out, and obviously you have to qualify for it. VA, you got to be a veteran or in the military in order to take advantage of the VA. The USDA, you have to be in a certain rural area according to USDA in order to take that loan out. But those both products require zero down payment, which is awesome because you don't have to put any money down in order to purchase the home. But there are some other cash that you might have to come up in order to close on your home. The most popular one by far is the FHA. It's 3.5%, so as low as 3.5%. And so you take 3.5% of your purchase price of your home, and that would be the down payment required in order to close on your home. The last one here is the conventional loan, and this usually starts at about 5%, although some will take as low as 3%, but kind of the standard average here is about 5% or really 20%, but 5% is the minimum usually for a conventional loan. So these are the three most popular or four most popular loan types and their required down payment. So 0%, 3.5%, or 5%. So down payment, an important part to the mechanics of cash to close. Now, the next bucket is our closing costs. These are costs related to the sale of the home and the issuance of a mortgage. And I say that it's also the issuance of the mortgage, but it's remember, if you're coming in with an all cash purchase, you might not have the mortgage related costs associated with someone who is going to take a mortgage out. Now, when we talk about closing costs, this could include property-related fees, loan-related fees, mortgage insurance, and title fees. So these are some of the types of fees that are associated with this closing costs. Now, closing costs can run anywhere from about 2 to 5% of the loan cost, and that comes from us from nerdwallet.com. So it can be a significant amount of our cash to close. So it's important to understand that when you're saving to purchase a home, you're not just saving for the down payment, you're also saving for the closing costs. Now, there are ways to mitigate the closing costs. You can put an offer in that asks the seller to also give you closing costs or a portion back in closing costs. If you are in an area where you have new construction, you might have a new construction builder that's willing to give you closing costs if you use their preferred lender. So if you use their preferred lender, they may give you $5,000 in closing costs, which you can apply to these closing costs, further reducing the amount of cash that you have to bring to the table to close. So there's a lot of ways to pay for closing costs, but we also have to remember that at the worst case scenario, when it's a seller's market and it's it's easy for a seller to sell and it's hard for a buyer to buy, there isn't a lot of advantages for a seller to give up closing costs when they're selling their home to you. So we want to understand the strategy behind all of that in order to ask for closing costs when we purchase a home. The last bucket here is that prepayment. So prepayments are costs related to insurance, taxes, and other expenses your mortgage company is going to pay on your behalf. The big three here when we talk about prepayments are homeowners insurance, property taxes, and the guaranteed fee, USDA mortgage insurance, or private mortgage insurance if you go with a conventional loan. So there are these types of prepayment. Now, let me kind of walk you through it. So your homeowners insurance, when you go to the closing table, you're going to need really two things when it comes to homeowners insurance. You're going to have to prepay your next year's home insurance, because what the title company is going to do is they're going to take that money and cut a check almost immediately back to your insurance company, and that's going to pay for your insurance between the day you close and 1 year later. Okay, so that's what you're going to have to pay at closing. You're also going to have to pay usually a buffer or a reserve of 2 or 3 months to the mortgage company. Now, the mortgage company is going to hold that in something called an escrow account, and they're going to accumulate that escrow account over the next year, so that when next year comes, they're going to pay your home insurance the next year. Now, a lot of people wonder, like, why does this happen? Why can't you just go out and pay your insurance company yourself? And the reason why is this reduces the risk on the mortgage owner. So the lender, this reduces the risk because if something happens to your home, they know that you have homeowners insurance on it because they're the ones that have been paying the bill on the insurance. And so they're collecting it on your behalf so that they make sure that that homeowner's insurance gets paid every single year, because if a fire happens, their loss or the risk of loss is reduced, because they know that they can or you can file a claim for that loss and then pay back the mortgage company for that mortgage. So homeowners insurance, it's prepaid by the mortgage company on your behalf. You get to choose your insurance company, so that's all in your rights, but they want to handle the payment to make sure that there's always homeowners insurance enforced while you're living in that home. The next one here, property taxes. So something about property taxes is, depending on what state you're in, you might be paying property taxes in arrears, which is after the fact. And so the mortgage company wants to make sure that you're paying your property taxes, so they're going to collect at the closing table an amount that's going to start your property tax escrow account. And so they're going to take that amount and continue saving every time they receive a mortgage payment from you. And then at the end of the year, or whenever your property taxes needs to get paid, they're going to pay that taxes on your behalf. Same thing as homeowner insurance. It reduces the risk for the mortgage company, because they're not worried about foreclosure of your home due to unpaid property taxes. So that's another prepayment that's going to be handled by your mortgage company. Often nowadays, that is not necessarily a choice, but that's required as part of the mortgage package. And then the guaranteed fee. Now, there is a guaranteed fee for USDA mortgage insurance, but I often think about this as your general private mortgage insurance or your mortgage insurance. This is if you've paid less than 20% down payment on a home. There's something called a mortgage insurance to basically reduce the risk that a default will happen, especially since you're putting such a low amount. You're not putting the standard 20%, you're putting less down. So that might come out, depending if you put 20% down or not, that amount will be part of your prepaid as well. So those are just some examples of prepaid items that you're going to have to bring to the table. Now, the mortgage company will calculate a prepayment margin that they will require at close to initially fund your escrow account. So that's that prepayment. You're prepaying 2 or 3 months, and that's going to stay in this account. And then annually, that account is going to get revised based on actual expenses that the escrow account had to pay. So when we think of what goes into the cash to close at the most basic level, this is how cash to close will be calculated. We're going to start with your home price. We're going to add closing costs to that. We're going to add prepayments, and then we're going to subtract the mortgage amount. So the mortgage amount theoretically is going to reduce the amount of cash that you have to close at the closing table. So notice how we have the home price, we don't actually have the down payment. If we take the home price and subtract the mortgage amount, we would get the down payment. So we're going to subtract the mortgage amount. We're going to subtract any seller's contribution. This is when you put in an offer on a home, you ask the seller to pay some amount of closing costs on your behalf. So you might ask for $2,000 in closing cost assistance, and that $2,000 goes to this transaction cost. Then we're going to subtract earnest money. So when you put a contract, if you put an offer up and it becomes a contract, which means you're contractually obligated to purchase the home, you're going to be required to put earnest funds up or earnest money up. So that might be 1% of the home price. So if you buy a $200,000 home, typically most offers will include a 1% earnest fund. You get that back and it's applied here if you go through with the process, but you're going to put 1% up when that offer turns into a contract. So 1% of $200,000 is $2,000. So you're going to write a check for $2,000 to your title company, and you're going to turn that in with your actual contract to the title company or escrow officer. And from there, that $2,000 basically is a way for you to tell the seller that you're serious about buying this home. So once they have all of that together, that earnest money is then put aside, and then it is applied back here at closing. So we're going to subtract that from all of these costs of buying a home. And then we're going to we could subtract option money. Depending on what state you're in, you might have an option money part of your contract in which you are basically saying, hey, I'm going to give the seller X amount of dollars to have X amount of days to be able to cancel the contract for whatever reason. Typically due to inspection is the usual reason why you're paying the option money. You may decide to apply that to closing, and that's what that is here. It's usually a very small amount in comparison to everything else, so it really isn't a big deal breaker if you don't get it back at closing, but in some instances you can get it back to closing. So once we have all of that, that's going to give us our cash to close. This is the amount of cash you need to bring to the table in order to close on your home. The cash to close is the cash. The cash to close is the amount required before you can close on your home. The most important thing is to make sure you verify this number with your title company or your mortgage loan originator. Typically, you're going to be your title company so that you are not short when you come to the closing table, especially if you're going to bring a certified check. Because if you are short, they can't close on your home until you actually bring everything necessary to close on the home. So super important to verify that, especially a couple days out before you're actually going to close. And your title company should have that information to you anyways, but you want to verify that amount. And also as a reminder, as we talk about cash to close here, if you're going to wire funds to your title company, make sure you verify the wire account number directly with the title company and no one else. Now, it's important to do this because when you start that process of purchasing a home, information starts to go everywhere, and there could be instances where someone's going to send you an email as if they are the title company saying, hey, you're closing on your account, you're closing on your home, please wire funds to this wire, account number and routing number. And what you're going to find out is they're spoofing that email, and so it seems like it's coming from the title company, but it's not really coming from the title company. And so you're stuck with this odd thing where you wired this amount of money to some person or some entity that isn't really the title company. So my suggestion here is you have the phone number to the title company, call the title company, ask for your escrow officer and say, hey, can you confirm to me the wire account number and the routing number that you want us to wire the funds to close on our home? And once that they've double checked it with you, then you should be good to wiring the funds to the title company. It's also important to wire the funds to the title company about a day or two before closing so that they have it on record, because a lot of times they can't close unless they've received those funds. So don't wait till the day of closing, because you could be an instance where you have to wait and wait and wait and wait for those funds to actually arrive to the bank account of the title company. So that is a look at cash to close. Super important to understand, because as you're starting to look to purchasing a home, or maybe you want to be a homeowner, it's not just the down payment that you're going to need. You're going to need other closing costs and prepayment. And again, some of this can be negotiated in your offer to the seller, but in a hot market where it is a seller's market, there's very little advantages for them to do that, or very little willingness to do that, because they know that they can just wait and another offer will come that's requiring no concessions to closing costs, and they'll save themselves money in that type of market. So make sure you hire a real estate agent to help you understand all of that. So I hope you enjoyed this video. What is an important factor that you learned in this lesson? So, what did you learn about closing costs? Put that in the comment section below. And if you like this video, make sure you press the like button. Don't forget to subscribe and turn on the notification bell. And until next time, we'll see you in another video.